Today on Inspired Money.
That's what I feel like. To get to financial independence, you got to really kick it in the butt for a few years and grind out and save money in the beginning. It's like that. Most of the fuel to get the rocket ship off the ground, like 2 inches off the ground, is expelled in the beginning. So that's what I did the first few years. I just saved a boatload of money.
This is episode 97 with passive real estate investor and creator of SimplePassiveCashFlow.com, Lane Kawaoka. Welcome to Inspired Money. My name is Andy Wong, a managing partner at Runnymede Capital Management. Each week, we bring you an interesting person to help you get inspired, shift your perspectives on money, and achieve incredible things. From making it to giving it away, Inspired Money means making a difference, creating something bigger than oneself, and maybe, just maybe, making the world a better place. Thank you for joining me. Hey, Inspired Moneymaker, welcome back. If it's your first time listening, welcome. Inspired Money is different from other personal finance podcasts because we don't want to just learn how to live with money. We want to help each other to live richer lives, make a greater impact, and together, make the world a better place. Have you ever wondered how to invest in real estate, or if it's a good path to passive income? Today we're talking with Lane Kawaoka, who lives in Hawaii. He was a licensed professional civil industrial engineer, but recently quit his job, put an end to the rat race, as Lane likes to say. I learn a lot in this episode, and Lane really is an interesting guy. He likes to buck conventional thinking and learns by doing. His story includes a time when he saved $40,000 to $70,000 per year and how he invested his savings to achieve financial freedom at the young age of 33. In this episode, you'll learn how to get started in real estate investing. Lane will take us through his experiences from renting his first place to growing his investment portfolio, why you should think of cash flow rather than appreciation, and how to go from investing in single family to multifamily and syndication investing because it's more scalable. Now let's get inspired with Lane Kawaoka. Lane, welcome to Inspired Money. I'm so excited to have you on the show.
Hey, thanks for having me, Andy.
Yeah, let's jump right in. What's your earliest childhood memory of money?
Well, I think the first one was my first job was in Maui picking pineapple, which is a very horrible job where you go out in the sun, you put all this stuff on your arm, and then you kind of trudge through 3-4 foot high pineapple bushes for 8 hours a day, all for like $45. At the time, I'm 33 years old now, but at the time that was like $7.50 was like the wage. And that was hard money. And I vowed never again to like trade time for my money like that again. So I was a pretty good kid growing up, and my parents told me to go to school, get a good job, and work at said job for 80 years or whatever. So I'm kind of a product of the linear path.
Yeah, I want to explore that because I know that you have your blog and your podcast, SimplePassiveCashFlow.com, and you recently quit your job. So congratulations on that. I think you can officially say that you're retired at 33. Tell us how you got started in real estate from your once linear path of trying to do the right thing, right? It's like you went to school, you got a job.
Yeah, so I graduated college 2007. And still on that linear path of this dogma to go buy your primary residence to live, which I don't agree with at all. We can talk about at the end probably. But so I bought this place, and because I was traveling for work all the time as a construction manager, I was never home. So I just decided to call up my old landlord that was my landlord in college and said, hey, can we like rent this thing out? So it was a $350,000 property. The mortgage was $1,600 a month, and then it rented for $2,200 a month. And for a young 22-year-old kid, that was a lot of beer money, right? $2,200 minus $1,600, cha-ching. And I really didn't like my job at all because my bosses were jerks, and I traveled all the time, and I would leave work on Sunday afternoon, come back maybe on a Friday or Saturday, be home for one day, and my life kind of sucked, which for most professionals, it does suck for the first couple of years. But I was like this combination of like this light at the end of the tunnel and this way to get out of the rat race really made me focus. So at that point, I started to listen to a lot of podcasts and read a lot of books and get a lot more sophisticated and just pour a lot of my focus into saving more capital to buy more of these things.
Have you always been an unconventional thinker? Or did it just kind of develop over time?
Yeah, I'm probably I'm a questioner. I don't know if you've heard of there's this lady. Her name is Gretchen Rubin. She wrote this book. There's four personality types that she kind of talks about, but I'm like a questioner. So everything like I question, like why do we have to work at our job for 40 years, right? Why is the stock market that way? Why they say it's hidden fees, but why is it that I can only get 8 to 10% in the stock market, but when I break down the numbers, I'm making like 35% when I'm my own landlord and doing it myself, right? Where did all my money go? You know, like I question things, and a lot of the people that follow my podcast are questioners too. I mean, a lot of them I call them propeller hats. Their mind just goes all of the time. They don't trust anything. They always just do the math themselves, and that's why I think a lot of engineers like myself are real estate investors too.
Yeah, well, attention to detail, that's important.
Right. I mean, the numbers don't lie. People do.
Yeah, that's true. So when you were renting out your primary residence, I know that you were traveling a lot, but were you homeless? Like, where were you staying when you came back? I think you were in Seattle.
Oh, good question. Yeah. So I have like this page on my website, simplepassivecash.com/cheapo, of all these like weird ways I would save money. Like I would take a shower at work. But for the first few years, like 4 or 5 years, I lived on the road. My company was like a traveling crew. So I just lived in the company hotel all the time. I mean, on the weekends when I was supposed to be home, I just stayed in a hotel, picking up supplies or whatever.
Did the company cover that?
Yeah, the company covered it all, and like they would pay for all the food and stuff like that. So I would like go to a buffet right before I came home, and then like intermittent fast for like 36 hours. I mean, there'd be times where this isn't like I can remember this is my life from like 21 to 24, where it would be like a little game, how little money of my own money I could spend.
So you gamified it for yourself.
Yeah. Yeah, but I was able to put away like 40 to 70 grand a year every year.
Yeah, that's really cool because I'm sure that there are a lot of people who are in consulting. It's similar. It's like they're on the road all the time, but I think most of them do not think about they can rent out their home and just live out of a hotel on the company's dime.
Right, right. And I think you said there's a lot of millennials that kind of, are listening. And I do work with a few millennials, and they have this. I'm like I don't even call myself a millennial. I know you probably would call me a millennial, but I don't really identify myself as a millennial. But like, that's what I feel like. To get to financial independence, you got to really kick it in the butt for a few years and grind out and save money in the beginning. It's like that. Most of the fuel to get the rocket ship off the ground, like 2 inches off the ground, is expelled in the beginning. So that's what I did the first, few years. I just saved a boatload of money.
So you were banking that, and that gave you the flexibility to do more investing. Since you were having a positive experience by renting out your home and collecting the delta between your mortgage and your rent that you were collecting. And I'm sure that you wanted to do more of that, right? You wanted to multiply that.
Right. So I bought another duplex in Seattle, saved another 60 grand to go buy that. It was a $250,000 property, and that brought in a couple $1,000. So at that point, I was a very unsophisticated buyer. I mean, I didn't know anything about rent to value ratios, the 50% rule for expenses, or what primary, secondary markets are, places to invest. Like, I don't think anybody should invest in Seattle, Los Angeles, San Francisco, or these primary markets, as I call them. just the numbers don't work. The rent to value ratios don't work there to be able to cash flow.
So those are some of the things that you learned early on. I mean, I know that you're a big advocate of learning by doing, and that's what you were doing. That's how you became more sophisticated. Can you go through some of those things? It's like, how does someone get started? And then talk about some of those things like the 50% rule and the rented value ratio.
Yeah, I mean, it's like, I think, if I'm putting myself in the shoes of someone listening, the first thing you could do right now as you're listening is you go to Craigslist or Facebook Marketplace is a good place, and just go look for a rental property. And, like you're a younger 20-year-old self, somewhere like a nice 1 or 2 bedroom, and then get the address, put it into Zillow, and figure out what it's going to sell for. Now, Zillow's not probably the best place to go get pricing, but it's better than nothing. It's good enough for this exercise.
Are there better places to go?
Well, residential real estate is based on comparable sales, so it's sort of all over the place. It's manipulated by emotion and the buyers. But if you were just throwing darts at the dartboard, it's good enough. And as I used to say, good enough for government work and for this. So what you're trying to do is you're just taking the monthly rents divided by the purchase price. So that first property that I bought, it rented for $2,200, and the purchase price was $350,000. So if you get a calculator, that's definitely less than 1%.
Less than 1%, yeah.
Right. The next property I got was rented for $2,000, and you divide that by the purchase price, $250,000. A little bit closer to 1%, but not there. And about 3 years in, I started to realize I probably shouldn't buy in primary markets. And primary markets are all the cool places to buy, and where a lot of us with cash and have free time to listen to podcasts and YouTube videos like Los Angeles, San Francisco, Hawaii, New York, Boston, Seattle,
New Jersey.
Right. Let me make this clear. If you're investing for cash flow and not really for appreciation, which I feel like is gambling, it ain't going to work, buddy. You're wasting your time. Unless you're going to find something that's 1% rent to value ratio in a primary market, but it's going to be in a war zone area.
So that 1%, it's an easy calculation, but it allows for some room for improvement. It gives you some latitude and leeway, right?
Right. It's kind of like one of those things you look at, and if it's under 1%, you don't even dig in even more. It's kind of like the first step.
Because you're not making enough.
Right.
The delta's not big enough.
Right. And I got a free analyzer on my website if you guys want to check it out, simplepassivecashflow.com/analyzer. And you can dig into all the line items like vacancy, expenses, repairs, CapEx, to why. That you can really understand why we're talking about you need that 1% rent to value ratio to make this be able to cash flow. But for now, just take my word for it. But if you want to dig into the numbers, that's how you do it.
So you started in Seattle. At what point did you actually start investing in a secondary or tertiary market?
Yeah, so when I got started, the prices were low, right? 2009, 2010.
Yeah, good timing.
Right, good timing. I mean, just like Bill Gates, the product of a good environment, right? Not necessarily a great coder, but I was a great coder in the right situation. So that was me. I had some money, but I was in the right time. But 2012 came along and the prices started to creep back up. And I thought my investing career was over because I was like, what the heck? These prices are going too high and I'm not cash flowing. And that's when I had this epiphany where, yeah, you should invest in primary markets for cash flow. So I was sort of forced. This is a pivot point. I was forced into buying properties out of state, thousands of miles away, where I'm not going to be able to even see the property before I buy it. And but if the numbers make sense, pull the trigger and make sure you go through a proper due diligence period to ensure you're not buying a lemon.
So you're comfortable doing that. You found ways to mitigate your risk, investing in properties that you're not geographically close to. Right.
And I'm saying you don't even need to visit these properties as long as you work with people that you know, like, or trust. And part of that is building your connections with other passive investors.
How hard is that to do? I mean, you've been at this for quite a number of years now, so you've built that network. let me ask this question before we get into that. Can you compare like a passive real estate investment versus a more active one?
Yeah, so active real estate investing is all the traditional stuff you hear about, like wholesaling, flipping houses. These are all jobs. They're not investing.
You see that on TV a lot.
Right, and it's really entertaining, I guess. Like, I mean, it was a very short interview, but I was interviewed to be on one of those shows. So I told them what I did, and I was like, they're like, "All right, man, this is really boring. This is not for TV." And I'm like, "Well, you know what? All right, cool." But people get all wrapped up into, active real estate investing, and that kind of leads into, my first point, like why is it hard to find other passive investors? Well, if you're a passive investor, you need some money. So automatically that clears out 80% of the room, right? You need to have at least $20,000 to go use as a down payment to go buy a $100,000 house. So if you don't, this is real estate investing is what I do. You need money to invest. If you don't have money, you have a money problem.
So that's the basic budgeting to get started. Like if you're looking at a $100,000 or $200,000 property, you're saying, okay, I need to save enough to put the 20% down, and then hopefully you can borrow the rest.
Right. I don't do no money down. I don't know how you do those things. I just go to work at my job, and I use that said money to go buy properties with normal, conventional Fannie Mae, Freddie Mac, government subsidized financing. No tricks, no games. Tricks are for kids. It's simple.
And cereal.
Right. I don't eat cereal either.
That's because you're intermittent fasting. You're not allowed to have breakfast.
Yeah, I asked that question about 10 years ago. Why are we all eating this garbage that's just made out of sugar at the end, that just converts down to sugar? But I digress.
Okay, so we understand the difference between active and passive. Passive, more boring. And part of being passive is that team that you were talking about. You have to find the right team because you need a property manager to be doing the day-to-day management. I guess accounting for that, does a passive method, are you giving up some upside because you're paying somebody else to do the day-to-day, or not really?
Well, you're usually paying them about 8 to 10% of the income, but that's why you get the 1% rule, so you can pay people like that to do your dirty work for you. So there's an intermediary step between finding these property managers, brokers, realtors, and which is probably more important because you'll cycle through property managers and realtors. These guys are a dime a dozen. The key is to finding other passive investors. And one of the hard things that I found is, they tell you go to all the local RIAs, but the local RIA is where you find all the broke people there. That's inherently why they're going, because they're broke. They hear real estate is a great way to get unbroke and make money. And that's where you'll find a lot of the more active real estate investors doing flipping, wholesaling, all that sort of stuff. And I never really like wholesaling. I mean, wholesaling is more like you just market a whole boatload of stuff out there, and then in my opinion, you kind of take advantage of people, the 3Ds, death, divorce, despair. They make offers on these people who are in distressed positions for 50 cents on the dollar, and they resell it for 70. I mean, I want nothing to do with that. I believe in karma, and I'm just going to buy a ready-to-go turnkey property that's, not taking advantage of anybody. But hey, if you need the money, that's one way of doing it, right? You can sell drugs, you can go work at your day job. However you need to get money, you can make money, but that's not my thing.
Are you unique as a passive investor because you have the podcast, the blog? I know that you have a Hui Deal Pipeline Club. Like, are many of the passive investors just quietly doing their thing because they've got money? They don't need to do this with fanfare.
Yeah, I mean, you read my mind. Like, most passive investors are pretty affluent and they enjoy their privacy and they got kids to protect. They're not a bozo like me who made a podcast. But let me just say, it's having a podcast. I mean, I have like 2 or 3 calls with new investors every single day, and it's a great way to expand your network. I'll tell you that.
So that's a benefit to you,
right?
Expanding the network.
Right.
And then, I don't know, what's your other motivation for doing it? Is it to have a positive impact and help people who were in the position that you were once in?
Yeah, I mean, that's how it started. Like, a lot of my friends who, when we were in our mid-20s, we started to accumulate some money, right? And they're always asking me, like, how are you buying these properties from across the country? And so I tell them, and I'd waste like 2 hours talking about it, and then nobody would ever do anything, right? That's just the nature of the beast. Whether it's personal finance or diet or exercise or whatever, people don't do anything. So what does a millennial do, I guess, but make a podcast or blog? And now people who are interested in the topic material come to me, right? That's like the coolest thing, and I get to filter my tribe coming in. And then I realized that the people who come through that portal, they actually want to invest with me. So what better place for me to find partners to go into larger deals, get better deals through this platform.
So you got started with single family homes, and I've heard you talk about that's a good place for people to get started, to cut their teeth, to get some experience. If you're going to go to a secondary market or tertiary market, and then maybe you can talk about the different classes, like then how does one get started?
Yeah, so, let's assume you find a few people that you've built a relationship with, and, they're willing to help you. Of course, there has to be a good even value exchange. You don't want to be the guy who just asks 1,000,001 questions. We call them ask holes.
Can you find them online, or is the best place to start like asking a friend of a friend of a friend and try to find somebody in a specific city or state?
Yeah, I mean, there's internet forums out there. There's a lot of like Facebook for real estate investors, essentially. But in my opinion, they're mostly broke people, right? That's why they're trolling around on forums. So the advice may or may not be there. Again, and then you can ask a friend who knows a friend who does real estate, but that's likely going to be more of that crowd too. 90% of real estate investors out there, I got this data from Fannie Mae, Freddie Mac. They figured out all the loans that investors had for, investment grade stuff out there. And they found out that people who had these rental properties, your mom and pop investors, 90% of them only owned one property. If you're doing this right, you should be able to have 5, 10, 15, 20, 30 properties. No problem. It takes a while, but you slowly build up and the cash flow helps buying the next one. So 90%, what that tells me is 90% of investors are doing this entirely wrong, where they're using the cash flow to pay down their mortgage as opposed to going out and acquiring more assets that produce way more income.
Is that for investment properties only, or do you think the 90%, that's their primary residence?
That's only for non-owner occupied properties. So that's only for investment properties. I mean, I can't even imagine to think about the people with primary residences, the amount of debt equity they have in there. Don't get me started on that, but that's, you're trying to help out people who are willing to take the leap, right? And it's investors first. Those people are, they're doing it wrong, right? So if you're going to go out in your network, likely you're going to find one of these people who's doing it the right way.
So you need to find somebody that you can trust to keep you out of the bad class and like terrible neighborhood where it could actually be dangerous.
Right. But most investors, real estate investors, are doing it the wrong way, where they're investing for appreciation in a place like San Francisco. And it's the old school way. And
you think the numbers just don't bear out. You can't make it work. The cost is too high.
The counterpoint is, well, the price will likely go up. I mean, yeah, you're right, but that's gambling. Like, rule number one of investing is don't lose money. Invest on the sure thing, which is cash flow. On a month-to-month basis, the asset pays for himself and puts a little bit into your bank account each day. And from like a personal finance perspective, that's all we're looking for at the end game anyway, right? Cash flow. It doesn't matter if you grow your portfolio to 2 million, 3 million. That doesn't matter. You have to convert it to cash flow. So why not have the end in mind and do it from the start?
Is there a sweet spot for like average cost of a property that you're looking at, or location right now? And how do you evaluate? Yeah,
so I guess to your earlier question that I dodged, like the class of properties, like, so you've got A, B, and C class properties. So A class is like your luxury, new build condos or single family homes. those without a doubt will not cash flow, right? These are your $500,000 houses and they rent for 2,000, right? They're usually going to be around 0.5% rent to value ratio. Not going to work.
You think irregardless of whether it's a secondary or tertiary?
Right. I mean, I've got one house in Birmingham that appreciated a lot. It's $250,000 market price, and it only brings in 1,500 a month. That's more of like A minus class property in Birmingham. It's a real nice house, actually, nicer than what I got here in Hawaii. That's 5 times the value. But yeah, so then the next one is like the B class. So the B class is more like white collar, blue collar mix. So your average person, with decent income, making like 60 grand a year or something like that. And then your C class is like the one class down. These are more like your 1970 properties or older, 1960 properties, blue collar workers, your Walmart worker. You might have somebody who works construction. I mean, construction jobs are good jobs. And then the D class and F class, which we call war zone. So the sweet spot is right around the C and the B class. You want to, the term is good, workforce housing, affordable housing, where you're going to rent that thing for anywhere from $700 to $1,000 a month. That's kind of the sweet spot, in my opinion, because you want the rent to value ratios needed to be able to cash flow, which you're not going to get on the A class side. Yet you're going to get better rent to value ratios on the low end, but it's just going to be too much headaches. I mean, your property manager is going to need a gun to go collect the rent on that low end.
Okay, and in the evaluation process, you're like the quarterback, right? You have like a team of people. There's going to be a broker involved. There's going to be a property management company, maybe. Like, who are the players, and how are you doing this remotely to get everybody to work together and sort of check up on each other to make sure that you're making a good investment and a good choice?
Right. So hopefully you went off good referrals, right? You built relationships with the right passive investors to get the right personnel, which should make your life easier. But you still have to manage the managers, and you have to set your expectations. I mean, I think a lot of professionals working today work remotely from their boss. So it's no different, usage of email, phone calls. The key thing is keeping people accountable. The trouble is, if you've never done it before, it's hard to keep people accountable, right? Like, it's like me working with a computer programmer or VA. Like, I don't know what the heck they're doing. It's a black box to me. So that's difficult. But to kind of take it, you're just going to get better and better. And part of this is just learning. Your first investment is not going to be the greatest, but you're going to learn so much. And then the second one's going to be so much better.
Is the starting point usually with the broker? Is the broker introducing prospective properties?
In my opinion, the starting point is the property manager, because that person is sort of aligned with you. They don't want to manage a piece of junk property and a bad tenant, right? And they're going to be able to fact check that property's rents for you. I mean, you should be doing this yourself. You can go to rentometer.com. You can go to like Facebook Marketplace. You can go to Craigslist and figure out yourself. But the property manager is really the person who's boots on the ground, who's going to be able to say, let's not buy that one because it's next to 2 crack houses, right? And that's where these personnel always come from. Lending brokers, mortgage, real estate brokers, don't trust them, right? Because they get compensated when they close the sale. So hopefully you find a good one that's agnostic of which property you buy, and they're just here to help you for the long-term relationship. But it's not always the case. And most of the time, these brokers, they're not investors themselves. So they don't know.
So they're not looking at the property through the same lens that you are.
Right. But it's a chicken and egg thing, right? How do you get the knowledge if you've never done it before? So, which helps, that's kind of where the mentor part comes in, or you have people around you that can support you.
What are the different types of investments that you're making? Because I know that it's like single family home, there can be apartments. So as you grow your experience in your portfolio, what is a natural progression? What does that look like?
So you go out and you get that next property, and it'll probably be light years better than the first one. And then you just rinse, wash, repeat. Every property you pick up that's like $100,000, should put an extra $100 to $300 of extra cash flow into your pocket every month. So as you can see, you're kind of building upon, them slowly.
Coming up, we talk about scaling up to syndication and other more scalable investments, why Lane thinks you should not own your home, and more. But first, this is not a get-rich-quick scheme, but a long game.
If you watch my progression, it took me forever to get to 10 rentals. It took me like 5-7 years, I think. It's like watching grass grow, actually. But after that, it just exponentially grows from there.
The show notes for this episode can be found at inspiredmoney.fm/097. If you're listening in your car or wherever you are, check the show notes if you want to learn more about Lane and other things mentioned in this episode. It's time for the Runnymede Money Tip of the Week. In this episode, Lane covers lots of benefits of real estate investing. For balance, I want to mention some of the cons. After all, I want you to have a complete picture before you dive in. As you've heard, this is a slow game. While there's always a temptation to flip a property to get rich quick, real estate investing is rarely fast. Offers, counteroffers, appraisals, inspections, financing, all of that takes time. Dealing in real estate typically requires a lot of patience. And then there's liquidity. Real estate is usually not liquid, meaning that you cannot jump in and out of real estate very quickly. That means that it's difficult to convert the asset into cash if you need it. With stock investing, if you make a mistake or change your mind, you can usually sell quickly, even if you have to take a little loss. Real estate is tougher though, and for this reason, buying at the right price is important. If you buy a property at the top of the market, it can take an entire market cycle, possibly 10 years or more, to get your money out without taking a loss. And despite many success stories, real estate investing is not all easy. Real estate investing can be difficult and time-consuming. Properties must be managed on a daily basis, including vacancies and bad tenants. Lane uses property managers to handle the day-to-day, so he talked about his approach is more passive than active. But even still, even Lane has had bad tenants in the past that have wrecked his places. This can require tremendous time and money to repair. It could cost $10,000 or more. Given these realities, if you want to start investing in real estate, I suggest starting small, because it can be a lot less expensive to make mistakes on a smaller scale. That's the Runnymede Money Tip of the Week. Inspired Money is brought to you by Runnymede Capital Management. We help you to plan, invest, and worry less. So what's your biggest financial challenge right now? Do you have an account that you haven't been paying attention to? Maybe your 401k or an old IRA that you rolled over? If you have questions, go to inspiredmoney.fm/Andy to send me an email. Or if you want to chat one-on-one for 15 minutes, go to inspiredmoney.fm/15. We can talk about your investments, the economy, this podcast, anything you'd like. I'd love to hear from you. You're listening to Inspired Money. I'm Andy Wong. So what did that look like for you? Once you had 10 properties, was that success in your mind? Like, was that a goal that you had set early on or not really?
Yeah, it was kind of a goal. You get capped at 10 Fannie Mae, Freddie Mac government subsidized loans. What some people will do, they'll put 10 in their name, 10 in their spouse's name to get 20. But if you do the math, 10 rentals at $300 a piece, that's $3,000 of passive cash flow, right? That's not enough for an engineer who makes $100,000 a year to quit their job, right? It definitely is a nice third paycheck for sure. But at that point, you start to realize that syndications and private placements are the place you should head to next and to scale up.
How much sophistication does that require? Because just the names alone sound a little bit intimidating.
It's very intimidating, but it's actually very simple, and you can get really dumb being a limited partner in big syndications. It requires no knowledge. It just requires money. Most times, to go into a private placement, the minimum investment's like $25 to $50,000, and you're just kind of making the bet on the front end. You're entirely passive. You don't have to do anything, and you sign this long private placement in the random, and you invest like that. But I always tell people, like, you got to start off doing your own deals first to understand this stuff, because that's where things get difficult, is vetting the deals from the get-go. And there's some shady characters out there, without a doubt. And it's a private placement world. I mean, yes, the SEC is involved.
Right, but it's less regulated.
Right, right.
Is that for accredited investors only?
Most people think that, but 97% to 90% of deals out there are for non-accredited investors. So the rule is, if it's a 506B deal, which most syndications done through that manner are, they are accepting non-accredited investors also, but the investor has to be sophisticated, which, I'm not a lawyer, a syndication lawyer, but that term is very gray, right? You certainly have to own some rental properties and know the risks of real estate, that you can lose your money. So the problem is, most people aren't in that network, right? So, that stuff we said about growing your network in the beginning, well, that should exponentially grow much faster than the money you're making. And then by the time you have enough money, your network should be at a place where a lot of your peer group is going into these larger deals with you, or at least referring you to which ones to be going into.
How do you find those? I mean, besides, are you just relying on the network because you're surrounding yourself with people who are doing similar things?
Right, right. And a part of it is like growing with these people that you started with. I mean, I mean, people call me all the time. I can give you all the referrals you want, but it's going to cheapen it. It's not going to help you in the long run. The best way is to do it organically. Find a group of people who you're starting out with, so you can grow that relationship, that you trust each other. Heck, it's more fun doing it that way too. But then when you kind of, 5, 10, 15 years in the future, when you're going into bigger deals and you're deciding whether to put the 50 grand here, 50 grand here, 50 grand here, you have a few people to, bounce ideas off of, who don't have a, dog in the fight, and give you an honest answer.
You set up I think it's MFPE Investments LLC. What are you doing with that LLC?
So that's just I have a lot of LLCs, but that one's just my holding company for my own personal investments. So today what I'm doing is, I had 11 rentals, and at that point I realized that owning your own rental properties is not very scalable. Again, it's the place you should start out, but maybe you just start off with 4 or 5. Don't be like me and buy 11 of them. And then, so what I'm doing is I'm selling off my properties one by one, and then putting the money into bigger syndication deals. So last year I sold 7 of them. So I have like 4 left, I think. 4 rental properties left. So which is nice, right? So I don't have this big bunch of liquidity just lying around making nothing. I can kind of place it as I get it into bigger deals. And bigger deals, they're very infrequent as they pop up. I mean, it's hard to find good deals these days to be able to place it into. So I'm probably in about like 12 to 15 syndication deals. So my vision is to diversify it amongst different partners, different asset classes, like multifamily apartments, mobile home parks, and then different geographic locations. I think I'm in like 12 states now. And then different business plans. Some are a little bit more aggressive. Some are development. Some are, most of them are cash flowing day one type of bread and butter investments, I call them.
Are you evaluating them on the same basis, just for the cash flow, or is it much different looking at a syndication opportunity?
So most passive investors, like I said, have a clue what they're looking at. 90% of my investors, I would say, how do I know that? They don't even ask for the profit and loss statements in their rent rolls. Even if they did have them, they would just confuse them, right? And that's, as a passive investor, you don't really need to know anything, right? You don't need to know that, you don't need to analyze the deal, but I know how to underwrite the deal. So what I do is I pull all the P&Ls and the rent rolls, I put it into my analyzer, I analyze it, and I run the numbers myself. If I like it, then I'll invest. Simple as that.
So you have a methodology.
Right, right. Because a lot of times on these private placements, you'll get this pitch deck, this nice shiny PDF with all the projections, but pro formas are just made up numbers. You have to figure out what assumptions they're using to come up with said numbers. So I just get rid of that thing. I just get the raw data and run it myself.
Now, I saw the number that you have like 2,500 investments. Is that the number that I saw? What does that look like? That because it's a huge number.
Yeah, it looks really cool, but it's actually not that hard to get, right? Like if you go into one syndication deal that invests in a 300 unit apartment, no, Andy, you're an owner of 300 units, right? So if you just combine them all up, yeah, I own like 2,600 units, but I own a very small percentage of each of those units. So that's that diversification piece.
And that's what you like to see because you're diversified into different geographic areas, different markets, and you're working with different groups too. It's diversification kind of across the board.
Right, right. I mean, most sophisticated high net worth investors, they don't put more than 5% of their net worth into any one deal. So that's kind of where, 50 grand here, 50 grand here, 50 grand there. The newbies will get pitched a deal and feel really special, and they'll unload $250,000 on it, and that their only net worth might be 500. Right? That's what you don't want to do.
So that's high risk because you're locking up too much in one thing.
Yeah, it's just not prudent, right? I mean, but the difference between that person and the other person is deal flow. You need to have a lot of deal flow because you're just picking the best that come by. I mean, I get probably 2 or 3 deals that come across my inbox every month, and I only go into once a quarter or so. I mean, those are syndicated deals. I mean, of brokers sending me deals, probably 100 a month or something like that. But I don't even look at them.
Well, thanks for sharing your experience and kind of giving a really nice overview on how one can get started and what it looks like down the road, what you're potentially working toward. I want to get back to something that you had mentioned earlier, which is that you don't believe in owning your primary residence.
Yeah, I mean, here in Hawaii or probably California is very similar. A starter home for a millennial is 600 grand, right? If you're going to come with a down payment of 20%, you're going to need $150,000 to buy that property. I don't know very many millennials without some parents' assistance that can save up 150 G's. But let's just say they did, right? You could have taken that money. It's the opportunity cost is what I'm talking about. You could have taken that money and you could have bought 5 or 6 single-family homes that are cash flowing you $200 to $300 a month, right? And that's just the cash flow. I think that's, if you do the math, 5 times, it's $1,000 to $1,500 a month, the cash flow. But that's only one of the 4 ways you're making money with real estate. The other 3 are tax benefits, which are hard to quantify, but are very powerful. The fact that your tenant's paying down your mortgage, so all the principal payments are going into your pocket. And the last one is any type of appreciation you're getting, which I don't really consider, but it's just kind of the icing on top of the cake. But that opportunity cost is huge. And then, a lot of times people will say, that Seattle property, I sold it. Well, you could have held on to it from 2016 to 2019, and you could have sold it for 100 grand even more. I'm like, yeah, but then I wouldn't have 2,600 units, right? And then the other point is for that young millennial, if they would have got that $600,000 house, now they have this $3,000-$4,000 mortgage every month, and now they're screwed. Their personal financial outlook is they have no cash flow, and when you have no cash flow, that's no oxygen. You have no options. You're stuck. You're stuck in that house. This whole financial world is engineered so that people stay in their houses. They just pay down that equity and they own that house and they have to go to their job for 40 years out of their life. It's this engineered system to be like that. They should take the money and invest it in rental properties or buy assets because your house is not an asset. So I'm very passionate about that because I think that's the biggest thing. That's the kiss of death for young people, even old people, to go buy your primary residence in primary markets where the rent to value ratios are under 1%.
Because you're locking up a big chunk of money. And the opportunity
Right.
cost is that you could be investing in several properties in another market and cash flowing that.
Right. And that grows and grows and grows and grows. Where this people see it, well, the property could go appreciate. Well, it's barely keeping up with the pace of inflation. Right? Do the math. Like, don't trust me. Go get a spreadsheet, figure out what the opportunity cost is if you invested it, and figure out how much equity you would have if you just sunk it into that primary residence. The math will tell you what to do.
What kind of term loan do you like?
I always go with the longest one possible because I think the debt is probably the best part of this whole deal. So I think that flies in the face of many financial bloggers where they're very debt adverse. But what you're trying to do is you're trying to lock up long-term debt today and pay it down with future dollars, which is going to be worth a lot less in the future. I mean, look, this country has a big debt, and the way they're going to get rid of it is not through taxes. Taxes will go up, however, but they're just going to inflate the money supply so the debt is, less in terms of future dollars.
That's the kicker too, though, right? Because it's like if you own all these properties and you have a 30-year loan, 30 years from now, you're going to pay off that debt and you're going to have these properties. You're either just you continue to collect rent, or, I mean, you're retired at 33, but in your 60s, you could say, now I have these properties, you have the flexibility to hold on to them, collect the rent, or you could sell them and take more money.
Right. But that's actually a good situation, but that's a bad strategy because a sophisticated investor will be looking at it in terms of return on equity.
You want to keep leveraging.
Right. So about the nice thing is when you buy these properties and it's 80 LTV leverage, your rate of return on your equity, your down payment money is very high. It's like 30% or so. But as the years go by, you have these C curves. So 5-10 years in the future, the property has gone up a little bit in price, which they typically does. But your return on equity is this, you're making the same returns. The rents might go up a little bit, but you have so much more equity that you could deploy elsewhere. So what smart investors do is they monitor this return on equity, and when it comes down to a certain point, you sell, refinance, or 1031 exchange into more properties and re-leverage yourself so you get that C curve up. So from the engineer speak, it's all about area under the curve. So you ride that C curve to, I would say, about 15% return on equity, and you re-leverage that thing, C-curve it back down, keep rinse, wash, repeat to eternity.
So you want to just keep building that portfolio and for your lifetime, and then hopefully you can pass that on to your heirs and they're continuing.
Right. But I mean, that just flies in the face of most conventional wisdom out there. Right? It's like, no debt, right? You got to pay off debt. But being debt-free is not aligned with financial freedom.
Okay, so you are retired at 33. So I want to ask you, and I like to ask all the Inspired Money guests, how do you define success?
Being able to do what you want, where you want, with whom you want.
Whenever you want?
Whenever you want, yeah. And money is not the end-all be-all, but it sure makes life a lot easier and gives you options.
So I know that quitting your job is new to you. What will life look like? What you know what I'm saying? What will Lane be doing now?
I think what I'm trying to do is, because I built up a platform where it helps real estate investors and, high-end accredited investors do some bigger deals, and then also kind of doing some just getting started. But I kind of want to work backwards to just the newbie people. So I'm kind of writing a section of my blog for just newbie people, people out of college, what the heck should they do, It's a little alternative. I tell people, don't put money in your retirement account, just invest it outside of those accounts for many reasons. But it's just a lot of this. I joined a lot of masterminds and got around very wealthy people, and the stuff that they do is very different from what you read in financial blogs, and especially what you read in newspapers and conventional wisdom. So to kind of bring that down to the regular people so that they can kind of live the same life and do whatever they want is kind of the vision. And that's what I get to focus on these days.
So you're learning a lot of good lessons and ways of doing things unconventionally that have worked for people.
Right. And they're pretty simple, right? I mean, flipping a house, wholesaling is very complicated, but a lot of these other techniques are very contrary, but they're very simple.
Yeah, that's great. Well, let's leave it at that. Thanks, Lane, for sharing your story and your experiences. Can you tell the Inspired Money listener where they can follow you and find out more about what you're doing?
Yeah, they can check out my blog, simplepassivecashflow.com, and then my podcast, Simple Passive Cash Flow, which is found on Google, iTunes, all those. And then I think a lot of people just get started buying a single family home. I mean, especially if you live in a primary market. I mean, the first 20 podcasts are kind of the places to be. Just listen to those. Those are free. And then that should get you started on the path to at least opening up to non-conventional investing, buying for appreciation, that kind of stuff, and getting more towards the cash flow.
Cool. Thanks, Lane. Really appreciate it.
Yeah, thanks for having me, Andy.
So what was your favorite Inspired Money moment? I really enjoyed talking to Lane in this episode because I learned so much. I really don't know much about real estate investing, especially passive real estate investing. So I found this episode really interesting and informative, and I hope that you did too. One of the biggest benefits that Lane talked about, and he mentioned that this kind of goes against traditional personal finance when it comes to debt, is the power of leverage. Leverage is the ability to use other people's money to purchase an asset. And with property, that comes in the form of taking out a mortgage. So assuming that you're putting 20% down, that means you're using 80% of borrowed money. When things are going well, like the market is going up or you have a renter that continues to pay your mortgage, that leverage can be really powerful. It's when things are not going well that leverage becomes a problem. It's in those cases where you hear about foreclosures and banks taking over properties. So it's a double-edged sword. You really need to be careful. Now, one thing that Lane mentioned that we didn't come back to is the 50% rule. And I wanted to cover that really quickly and not leave that open-ended. The 50% rule is a shortcut to save you time and to avoid negative cash flow. The 50% rule is another shortcut to estimate the expenses and ultimately the net operating income of a rental property. So the 50% rule is an assumption that you will only keep 50% of the rent that you collect on an average rental after paying for vacancy, management, taxes, insurance, and maintenance. This can be helpful when comparing one property against another, or to do a quick calculation to decide whether or not you want to take a look at a property. For more information, Google 50% rule and real estate, and you'll get more detail. I hope that you enjoyed today's episode and learned something. Thanks again for joining me on this mission. If you had a different favorite Inspired Money moment and takeaway, let me know by posting in the private Inspired Moneymakers Facebook group at inspiredmoney.fm/Facebook. The music you're listening to right now and all other music on today's show is by the amazing Jim Kimo West. Aloha, Kimo. Have an inspired week and do something that scares you, because that's where the magic happens.